This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
So this is the sixth meeting of the FOMC. It's done, Tim.
It is done. And we just wrapped up listening to Fed Chair Jay Powell talking about the decision and the economy and what's to come. Well, you know what, Carol?
What?
The Fed leaves rates unchanged, signals one more rate hike this year. Powell says central bank to proceed carefully on a rate path.
Carefully. How many times? It was like a drinking game. Every time he said careful or carefully.
I hope you weren't drinking during that.
Well, maybe some water.
You would be drinking a lot. And then 2-year Treasury yields, they went flat after that initial surge.
Unbelievable. All right, so let's get to it. I will say the Fed chief saying that there's so much uncertainty around the timing of rate cuts, and that was something I felt like in the press conference that reporters were trying to pin him down to, and he would not be pinned, although it does feel like higher for longer. All right, so let's get to it. Let's get some analysis because we did get an an update on those economic projections from the Federal Reserve, and that was certainly something we were all focused on. What we have with us, or who we have with us, a former Bloomberg colleague, Yelena Shulyatyeva, senior US Economist at BNP Paribas on Zoom in New York City, and then Bloomberg Economics US Economist, Stuart Paul. He's here in our Bloomberg Interactive Broker studio. Stuart, I do want to start with you. What are or were the key points of today's decision and what Jay Powell chose to stress in that press conference?
So Powell is definitely stressing that he's going to be maintaining a higher for longer posture. I think that some of the confusion that came from the press conference is that this is just a generally hawkish summary of economic projections. That's really the content of today's FOMC decision, is the summary of economic projections showing far fewer cuts in 2024, more optimistic GDP growth path. But for some reason, Powell, when he took to the podium, said that a soft landing is not his base case. It's almost as
what does
though
that
mean? I was
what,
very surprised to
so
hear
what,
that.
what does that mean? That means things are better?
No,
Tim?
I mean, I took it as bad news. I took it as, things aren't as good as people think.
Well, we here at Bloomberg Economics think that there is some softness underneath the surface. I think that if we're trying to analyze the intent of the Fed chairman here, we have to think that he's trying to invoke some sort of a memory of Volcker, which is that he's willing to do what's necessary to break the back of inflation. Yes, he's optimistic about growth. That's why the median member of the FOMC at least is optimistic about growth. That's what helps to explain the median projection for the Fed funds rate, maintaining that higher for longer posture, ending 2024 at 5.1% in the 5 to 5.25 range. And if the Fed is ever going to have to rein in inflation, maybe something might have to crack. That's what I think that he was alluding to when he says that a soft landing isn't necessarily his base case.
And Bloomberg Economics' Anna Wong writing, officials also completely scrapped a recession forecast for this year. Right. So definitely taking that off the table.
Hey, Yelena Shulyatyeva, come on in here. Senior U.S. economist at BNP Paribas, also our former colleague here at Bloomberg. Yelena, how did you read into that comment from Fed Chair Jay Powell? He would not call this soft landing a baseline expectation. What's your interpretation of that?
I think the chair is alluding to some event risk here. And I think there is a lot of things that could go wrong from now on. Yes, the economic growth looks really strong if you look at the recent data, but we have a confluence of significant negative risks coming all at the same time in the fourth quarter of this year. You have student loan repayments restart. You have a possible shutdown, excess savings are depleting. So there are significant risks to the soft landing scenario that is reflected in the summary of economic projections. They're really seeing a stronger growth, lower unemployment rate, and at the same time, much lower inflation. I think the event risks that will make them be cautious at the following meeting.
If you could have asked a question to the Fed chair, Yelena, what would it have been?
I think I wanted to hear a much clearer explanation of what he thinks about policy lengths. He alluded to that a little bit in the opening remarks, but the extent of how much previous policy tightening impacted economic growth, I would I would like to get a better sense of that. It seems like Chair himself believes that policy legs have not fully percolated through the economy and more impact is coming.
And Stuart, I want to ask you, process of getting inflation to 2% has a long way to go. So do I read that as, yep, we're not at 2% yet, so we get that, Chair Powell, or is it that also means you guys still have work to do? And so cool your jets, everybody who's thinking of Fed cuts.
The projected path for the Fed funds rate target range, at least for the median voter on the FOMC, seems to be almost separate and apart from the economic fundamentals that they're showing in their projections. We're not getting to the 2% core PCE target until 2026. So yes, the core PCE forecast was modestly revised down for 2023, but we also see growth being revised up. We see unemployment being revised down, labor market staying tighter for longer. That's not the higher for longer, the tighter for longer that the Fed had been looking for, right? So do those fundamental economic projections, those forecasts, scream one more rate hike to you? I mean, it seems as though, to Yelena's point, that maybe these optimistic projections are just that. Maybe they're just a little bit of a wish and something will crack in the background. Maybe it's something fundamental like Yelena was talking about that we've written about extensively. Maybe it's something like liquidity, and we haven't heard anything about QT in multiple press conferences.
Well, Yelena, Stuart raises a really good point. I mean, how seriously can you take the dot plot out 2 years? It's one thing to, take the dot plot projections out for the remainder of the year, but it's an entirely different thing to look at it for the end of 2025. How do you look at different times there versus what they're saying?
I think you really have to take it with a grain of salt, even going into the next year. We did notice that the range of projections for 2024 narrowed, but it's still a very wide range of totally different projections. And even this year, I think the fact that the Fed downgraded inflation projections, but they are still, I think, in our view, very high relative to what will likely happen. So in this sense, if inflation surprises to the downside closer to the end of the year, that will give them a way out of the last projected hike of the cycle. We think that they have reached the terminal rate.
Is there a word that you seize on in terms of what came out of Jay Powell's mouth today, Yelena?
In a sense,
is there a word that just, sometimes he uses a word over and over. Sometimes there's a phrase and we all kind of, that's in the headlines.
It used to be transitory.
It used to be transitory, data dependent, right? How many times have we said that? Is there anything that came out of his mouth that you thought, okay, this is kind of where this
data dependency, but that has been their mantra for quite some time. I think that they just want to be cautious with those, sticky words.
How about for you, Stuart? Was there something there?
No, the thing that really stood out to me was that Jay Powell didn't seem to strike, at least not to me, a single hawkish or dovish tone. Usually, at least over the past few years, when the FOMC makes a decision, so in this case, to hold rates steady, he'll end up striking a more hawkish tone to compensate for the pause in rates. Or if they were to hike, he ends up coming out a little bit dovish during the press conference to sort of tone down any sort of market reaction to the actual decision itself. That was not the case today during the press conference, at least not to my ear.
What did you hear?
To my ear, he sounded a little bit cautious. He used the word cautious multiple times. And they were just the same way that we see this sort of break between the FOMC's median forecast for the funds rate itself and its forecast for the economic projections. It seems that there wasn't a cohesive narrative, at least not to me, when I was listening to the press conference.
It's interesting, right?
Totally. To Stuart's point, if I may,
please.
There's a lot of risk management approach in what they're doing right now. Not that they have achieved the goal, but they're very cautiously moving along. It's risk management that is driving their decision at the point.
All right. So, okay, where do we go from here? And I guess it's, Yelena, what are the next kind of focal points for you? Is it just we're going to go from data point to data point? I mean, how do you think about November?
So we only get one more CPI report and one more payrolls report before the November meeting. So, I mean, they are saying they're data dependent, but there's really not that much data that they're going to get. I think what will keep them on hold at the next meeting is really the event risk. So again, I mentioned a lot of things that are coming that could influence their decision to be even more cautious in the near term. But I think by the time they get to the end of the year, to the December meeting, we will probably get a lot of data showing a significant slowdown in economic growth, and even further slowdown in the labor market. And eventually that would stop them from going another time, as they are projecting in the summary of economic projections.
Stuart, I like the way that Yelena described event risk, these things that we talk about that the Fed absolutely has no control over. Something that Jay Powell said, higher oil prices, sure. UAW strikes, student loan payments starting up once again. What's the biggest event risk on your radar right now?
I'm not sure this is entirely an event itself. It is a catalyst that's starting, but it's well signaled, right? We know that student loan repayments are going to be starting. In fact, student borrowers have started those repayments already, and flows into the Department of Education's coffers within the Treasury have already reached pre-pandemic flows. So that typically should, based on typical flows into the Department of Education, shave off something like 50 basis points from PCE spending on a monthly basis. I think that's what's biggest to me. Other things like the UAW strike, imagine that's temporary, shave something like 1 percentage point off of industrial production. That's the sort of thing that you get back, though, when they fire up the assembly lines again. Same thing goes with the government shutdown. We would not even see that show up in the establishment survey if any sort of federal agency still keeps workers on its payrolls, at least insofar as those workers will receive back pay when they are brought back to work. At the end of a shutdown, even a government shutdown wouldn't hurt non-farm payroll growth that much. But the extent of, look, the Board of Governors is sitting there on Constitution Avenue. It's the sort of thing that they would see firsthand when economic activity within the district slows to a halt during a government shutdown. So it's the sort of thing that can feel very scary to policymakers.
Right. I always think about with these kind of things, it's either kind of a one-off if it ends quickly.
Right.
The longer these things lag on, I assume the economic impact is so much greater. Yelena, it was kind of fun, I guess, to kind of watch Jay Powell deal with, trying to be pressured into, like, when do we cut rates? Like, when does it come? He says going into 2024, the time will come at some point, and I'm not saying when, to cut interest rates. So he's very careful about that. How do you think about when we will start to cut rates?
So in our view, we will slip into a recession, and that will be a modest recession in our view, but still that should push the Fed to start cutting rates. Another consideration is something that came up during the press conference is the level of real rates. So right. If inflation continues to slow down and it falls rapidly, that would push real rates much higher from where they are right now. They are already in a restrictive territory, and the Fed will just not want to keep pushing real rates even higher into the restrictive policy stance. So at some point, the Fed will have to cut nominal rates just to keep real rates from rising further. So, and we think that that time will come sometime in the middle of next year.
You have any thoughts on that?
No, I think that's generally right. I think it's in the middle of next year. I wouldn't be surprised to see something like 25 basis points a meeting starting from June, July. And it's exactly that. It's to maintain that constant spread between printed inflation and nominal policy rates, so that monetary policy stays sufficiently restrictive but not excessively restrictive. I think that just, Tim, to your question earlier, thinking about any sort of catalyst that could be shocking, that could materially change policy decisions. It seems as though people have entirely stopped discussing liquidity, and they've entirely stopped discussing the consequences of QT. but the Bank Term Funding Program has maintained essentially a constant balance. Banks are still continuing to borrow from the Federal Home Loan Banks, and we're still seeing deposits leaving the banking system because rates are materially higher.
You're talking about the fallout from the regional bank crisis.
Well, even preceding the regional bank crisis, as a consequence of quantitative tightening, the other aspect of monetary policy that's operating just sort of in the background, there is an attempt to soak up liquidity at the Fed. And though we always focus on the Fed's dual mandate, price stability and full employment or maximum employment, the sort of thing that could pop up in the background is a liquidity event. And those sort of events tend to be pretty convex. We don't really have the foresight of saying, student loan payments are starting in October again. They happen when they happen, and I'm surprised that it's the sort of thing that doesn't come up in press conferences anymore.
I mean, COVID happened when it happened. March
Sure.
2020 happened when it happened. These are things that, if you go back to 2019 and the summary of economic projections then,
Right.
nobody was foreseeing something like this, an event risk like this, causing the Fed to drop rates to zero.
No, exactly. I mean, I don't know. I mean, you think about this year, Yelena, and I feel like we've been all over the map, right? When it comes to, we thought kind of the world was coming to an end, mini end, with the regional bank crisis, but, we've dealt with crypto over the last year. I mean, there's been a lot of things that have certainly come at this market, but, here we have an environment where you see certainly equity strategists continuing just to kind of ratchet their estimates higher. But at the same time, I'm looking at, and stocks right now are down to their lows of the session, but I'm looking at, the rate moves today. Your 2-year at 5.14, 10-year at 4.3. I mean, 5-year at 4.53. I mean, are these the rates that we should anticipate we'll continue to see, certainly going into 2024?
Well, at some point, the Fed will have to cut rates, and we will see some movement on that front.
Right.
I think one thing I would like to highlight, though, is all these things that we mentioned in our discussion, like such as student loans and strikes and, the depletion of excess savings. We should not forget about that, even though we've been talking about it for a long time. Those things make the economy more vulnerable to exogenous shocks. So some type of liquidity events and other things that Stuart mentioned. So I think that the slowdown in the economy to the point at which it approaches somewhat some stall speed, that makes the economy really vulnerable to something that could happen that we cannot anticipate. And that's an important point. And this is something that we should be watching.
Yeah. I mean, there's a lot on the plate. Certainly a lot covered by Jay Powell today, but a lot for us to kind of continue to mull over, and we'll see how the financial markets continue to read it. Guys, thank you so much. Really appreciate it. I know you guys have had a busy afternoon watching all of this, so great to get your
Stuart
insight.
was here late last night. I saw you on TV late last night,
What
when
were you
we
doing
were getting
Are we
out.
doing a preview?
Australia daybreak.
Oh, yeah. Well, I mean, somebody's got to do it.
A lot of central banks right now, right? Making moves.
Somebody needs to talk about starts and permits. Somebody needs to talk about what to anticipate from the Fed. So it's been a busy day for us. Yelena, we miss you here at Bloomberg. Eliza says hello.
We do
Wish you
miss
all the
her.
best over there.
I miss you guys too.
Well, you know what? We love it when you get to join us, Yelena, and on Fed Day and anytime. So it's awesome to have you back with us.
Totally. All right, be well. Yelena Shulyatyeva, senior U.S. economist at BNP Paribas, as you know, a former Bloomberg colleague, and Stuart Paul, U.S. economist at Bloomberg Economics, part of the Bloomberg Economics team. Yelena was previously.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
All right, as you know, FedEx just out with earnings, stock rallying in the after hours. It's also been on a tear this year, as we talked about earlier, up more than, I think, 40% this year, but up another 4% in the aftermarket. Let's get to it and let's see what our Lee Klaskow has to say. He follows this company and the sector. He is Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst, and he joins us at BI headquarters in Princeton, New Jersey. And he, like us, has just been going over the numbers. Why the optimism, do you think, in the aftermarket, Lee? And first of all, thanks for being with us.
Oh, my pleasure. They beat expectations, so that's obviously a net positive. They beat by 80 cents. They also increased the low end of the range of their guidance by 50 cents, which is another positive. And the beat is what's telling us is that management is beginning to execute on its strategy to cut around $6 billion in expenses. FedEx for a long time has been a show me story, and they're actually starting to, I guess, not show me, but show people that they're able to execute on their plan. So, I think that's what's fueling the aftermarket increase that we saw. I think it's up like $10 right now.
Okay, so that's the good news, because I'm looking through this release and I'm seeing a little bit of bad news in here. So correct me if I'm wrong, Lee, but the improvement in operating results, I'm reading this directly from FedEx's press release, was partially offset by ongoing demand weakness. Talk to us about that demand weakness, where they're seeing it, and how long it's going to last.
Yeah, I mean, that's a great question. I think demand expectations are going to be weak because you have to remember demand is really normalizing from, some creamy highs that we saw during the pandemic when everyone was ordering things home. So, now that, people are getting back to normal, obviously people have been spending more on services versus goods. We've seen that trade happen already. So they're really going up against difficult comparisons versus anything that might be, in our view, like a real weakening of the consumer. We think the consumer remains relatively resilient. So that is really not a surprise. The good news is what's offsetting that is what they're doing on the pricing side. So, they just recently announced that they're going to increase rates next year by 5.9%. That's their general rate increase. Obviously, large shippers aren't going to pay that whole increase. They'll probably pay a discount of that. But what we're seeing is that they're going to be able to increase price to lower their inflationary pressures. And you can see, what they're able to do on the cost side. They mentioned in the release that they reduce the cost per package in ground to ship those packages by around 2%, I believe. And so that's good news. So that means that they're getting productivity gains. They're cutting some of the fat that FedEx had. And net, that's a good thing. So when demand does increase, when demand does go back to growth, they're going to be really well situated because that's really going to drive significant operating leverage and really good incremental margins going forward.
Lee, this was something we were just talking with our TV colleagues as we were breaking down the FedEx numbers as they crossed the Bloomberg. Should we be rewarding this company because they're good at cost cutting? This isn't about investing in CapEx, it doesn't feel like, right? Or, putting money to work, or demand is up a lot, or, the top line is growing a lot. Like, you know what I'm saying? That, and they've got another buyback, which always gets investors excited, or an additional buyback. So, or is it a case of, yes, reward them because, as you said, it's been a show me story. Now we're seeing the fruits of those efforts, and now they can go on to hopefully, growing into more demand. So I guess help us out here a little bit. Is it just the reward so much because, hey, you're good at cost cutting?
Yeah, and also you have to remember it's coming off of a low base, right, in terms of where their shares is today versus where it was a year ago. The street was really soured on FedEx for a number of reasons. A lot of that was just poor execution. And, they've come up with a plan. They're executing on the plan, which again is very key for them. They need to really show that they can execute. And if you look over the last 5 years, the shares actually have underperformed its biggest competitor, UPS. They are rewarding it today, but it's really a function of catch up versus necessarily something else.
Talk to us about the labor differences. Carol alluded to this during our simulcast, the fact that UPS is a story that is really a labor story with a really strong union.
I learned this from Lee when I was doing a big deep dive into UPS, and we talked a lot about the differences between the two companies.
But I mean, you look at a FedEx ground truck and, you look at the fine print, and maybe I just look at the fine print. Maybe not everybody does this. And you see that it's run by a company that is not FedEx at all. It's contracted out. It's just contract labor. These are not actually FedEx employees. Talk to us about the labor differences here.
Yeah, so obviously, there was in the news, obviously, a couple months ago with UPS kind of making an agreement with the Teamsters. That's their union that works and delivers all the packages. FedEx does have a union, but it's only their pilots. The rest are either employees or, as you mentioned, they're independent contractors. FedEx was an air freight network that decided to go into the ground business, and they did that in an asset light sort of way by really relying on these independent contractors. And there's hundreds of them across the country. They own certain regions. They're small business owners. They're able to sell those businesses to other people. So they operate as a small business. What I would say is with the new UPS contract and the fact that UPS is unionized, labor markets still are relatively tight. And if you're thinking about that's something maybe you want to go do for a living, working for a UPS where maybe you're getting a better rate per hour and your benefits are better, it might be more appealing. So from a attract and retain employees, UPS might have a leg up, but in terms of flexibility and maybe total cost per employee, FedEx obviously has the benefit. But if you look at the two differences, UPS's margins on the domestic ground side are a lot better than FedEx's margins right now. So that cost difference really isn't showing up in the profitability and the P&L.
In the press release, they talk about operating income up 18% during the quarter, as a 9% decline in revenue was more than offset by reduced operating expenses. It's what we've been talking about. That 9% decline in revenue, is that you talked about kind of getting back to pre-pandemic levels, right? Things got distorted during the pandemic. We know that. And I guess we keep trying to remind everybody, wait, we got to get back to kind of where we were. That's the reset. Does the FedEx numbers show that we are kind of closer back to that reset or pre-pandemic?
I think the jury remains to be out. My guess is that I think that we are closer to that. And I also think that, some of the things you're seeing on the yield side, some of the lower yields might be related to mix, but some of that business might still be more profitable for them, even though from a headline number it might not look that great. And you also have to remember fuel surcharges are kind of down from when they were a year ago, even though we're seeing higher fuel rates. What I was surprised is the FedEx Freight business, which is their less than truckload business. They had a lot of opportunity to win some business when Yellow went out of business, and so I thought there'd be more of a kind of a surprise on that side, but that segment actually missed expectations by a couple hundred basis points.
Okay, so what's the question you'd ask on the call if you were on there?
You're sitting down, or you're having cognac with the CEO, and you're like, hey, just between you and me, what are you going to ask him?
I can't believe you knew I was a cognac kind of guy.
Aren't we all?
I think I would want to know what inning they are in the $6 billion in cost reduction, and not only what inning they are in, but how much more can they really do? Because that's really the key. This company has to be really ready for the next generation of parcel. They're facing increased competition from Amazon. They're starting to do pickups, which is something that they had a test pilot project that they did before the pandemic, and they paused it. Now they're redoing that.
Right.
So they're facing competition from other areas. So they really need to be more efficient, and they really need to help their independent contractors be profitable, so they reinvest in their businesses and they're able to keep those high service levels up.
All right. So appreciate it. As always, Lee Klaskow, BI, Senior Transport, Logistics, and Shipping Analyst, joining us there from Princeton. Stock up, by the way, FedEx, 4%.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Bloomberg News reporting earlier this month observing methane releases from global oil and gas operations that were 30% higher than what countries estimate in reports to the UN. This is according to a new study, right? And it analyzed satellite observations of the potent greenhouse gas. It's really important. Yeah,
it is. The world's 4 largest oil and gas emitters, the U.S., Russia, Venezuela, and Turkmenistan, account for most of the overall discrepancy. That's according to a report published last month in Nature Communications. Satellite data, it just challenges, though, figures that reported to the UN, which rely on so-called emissions factors. Those are estimates for how much methane equipment might normally release applied to production and use rates. So it shows what you see in sort of one measurement
Correct.
might be different than what satellites pick up.
Exactly. And satellites, folks, they're everywhere. They're doing all kinds of things. You know that. And we're going to put that question because our next guest knows a lot about this. Let's head to Munich, Germany, where we find on Zoom Peter Platzer. He's a physicist, founder, and CEO, too, of the publicly traded microcap and global provider of space-based data analytics and space service. The company is called Spire Global. Peter, so nice to have you here on Bloomberg Businessweek. Welcome, welcome. Tell us about your business and what you guys are doing.
It's fantastic to be here. Thanks for having me. Spire was founded to leverage space and analytics to improve life on Earth, and infused with that vision, we designed, built, and now operate the world's largest constellation of satellites that use radio frequency technology, the technology that powers anything from mobile phones to the very show that we're on right now, to observe what is happening on and around Earth. We collect a lot of environmental data, like hurricane wind speeds and flooding and wildfires and other extreme weather events. And then we help our customers to improve their bottom line by reducing often their carbon footprint all at the same point in time.
Do you guys actually own satellites?
Yes, we own the satellites. We own orbit that cover the Earth every 15 minutes. All of Earth, everywhere, 24/7, and we invent.
Oh, we got to get those satellites fixed
so
we can get this interview going.
All right. I think, are you back? Oh, you're back with us. Okay. Go ahead. Continue what you were saying.
Oh, sorry. I was saying that, yes, we built and designed all those satellites, and we invented all the technology that sits inside the satellites, the sensors, and the software.
So explain how these satellites that you launch at Spire Global are different or similar to ones that are launched by SpaceX's Starlink.
So we call the satellites categories: looking satellites, talking satellites, and listening satellites. Starlink is a talking satellite constellation. They transport data from one spot on Earth to another spot on Earth. They are data pipeline, so to speak. Spire is a listening company. We use radio frequency waves to observe what is happening around Earth. So when you, for example, mentioned earlier, methane emissions, we are a platform for a customer that runs a sensor that measures methane emission from space. We have a sensor that uses radio frequency waves to measure hurricane wind speeds or flooding or rain or temperature. So we use RF technology, radio technology, to literally observe what is happening on Earth.
So I'm curious, how much of your business revenues comes from government organizations around the globe?
So about 45%, so a little bit less than half of our business is with government organizations. It has sometimes been a little bit more than this. It has sometimes been a little bit less. So maybe over a longer time frame, we say 50-50. But right now, it is about 45% from the government side and 55% from commercial companies.
So when investors look at you as a company, as I mentioned, you're a microcap, and let me just take a look real quick. $113 million microcap. You're down about 33% for the year. But how should investors think about you? We do classifications. We say information services, but it's interesting. I feel like you're playing into a lot of different fields. How should investors think of you? What kind of company are you?
We are a classic SaaS company. We sell data and analytics as a subscription. Our customers are extremely sticky. We have a net retention rate of 117%. So customers keep on buying more from us. We have guidance for this year is over $130 million of ARR. Growth rate over the last 6 years is over 100%. So we are a classic data and subscription company with the same metrics as you would find with typical SaaS companies, with the one difference that we have an extremely efficient sales force because we have these massive barriers to entry, and we don't really have to spend as much on sales and marketing as you see with other SaaS companies.
Peter, who launches your satellites?
So there is a rocket going up on planet Earth every, 2-3 days or so. We have launched with at least 10 different launch providers, 35 launch campaigns. So we have launched with, anyone from SpaceX that you mentioned earlier to Rocket Lab to Virgin to India to the Europeans, Vega. So a whole host of launch vehicles we have used to bring our satellites, our capabilities to orbit.
I'm wondering what you would say to critics who argue that filling the sky with satellites, a lot of astronomers say, it's really changing the night sky. It makes it look completely different than it looked just a few years ago. It's affecting the way that we can explore Earth. What would you say, or explore the solar system? What would you say to them?
So I think it's absolutely true that space is a common environment, just like the oceans or peatlands that we monitor, which is a great carbon storage and has huge impact on climate change. Space is a common good, and we have to treat it, very, very respectfully. Now, putting up very, very large devices, for example, does have a massive impact on astronomers. I would challenge any astronomer to see our satellites because they're the size of a bottle of wine. And they're not very shiny, so they're really, really very, very invisible. I think you have to treat it respectfully, which we certainly do. We clean ourselves up very, very quickly,
right?
And we do have to look at the benefits as well as the cost of leveraging this common good space.
All right, got to run. Hey, good to check in with you, and hopefully we can do it again in the future. Peter Platzer, he's the founder and CEO of Spire Global, joining us from Germany.
A little sublime. Yeah. This is Bloomberg.
How long can this go on? Better working in a coal mine, going down, down, down.
All right. Well, there is definitely working in a coal mine. And if you think about our history, right, not good conditions.
Yeah, and there's also working low-wage retail jobs here in the United States in 2023, Carol.
You mean like at a Dollar General?
That's exactly what I'm talking about.
Yeah, maybe not exactly like working in a coal mine, but yeah, wait until we get into the story because ick. Based on this week's Bloomberg Businessweek cover story, it also happens to be today's Bloomberg Big Take, you will find things like rat infestations, blocked fire exits, expired kids' food, machete-wielding and watermelon-throwing shoppers. It sounds funny, but it's really not. A lot of nightmares at the biggest dollar chain, Tim, in the United States.
With more on the story, which is reported out by Bloomberg's Josh Idelson and Brendan Case, let's bring in Brendan, Bloomberg News U.S. retail reporter, joining us on Zoom in our Dallas bureau, along with the editor of Bloomberg Businessweek, Joel Weber, here in our Bloomberg Interactive Brokers studio. The story, by the way, it is in the new issue of Bloomberg Businessweek. It's available on newsstands tomorrow. You can already read it, though, on the Bloomberg terminal and at bloomberg.com/businessweek. One of the most read stories on the Bloomberg terminal today, Joel. This is a deeply reported story with disturbing anecdote after disturbing anecdote. How does something like this come together?
Who knew that a story like this that has really changed what how a lot of Americans shop, I think, had this side to it. And so one of the things that struck me about it is that we've talked, I think, for a generation now about how big of a presence Walmart has had in America. And it actually is like the story that Walmart sort of, I think, propelled into America for like these big box stores and changing small town America. Dollar General has actually taken a lot of that farther now. The stores have a much, much, much smaller footprint, which we described in the story. The price points are amazingly affordable and seemingly inflation-proof, as we also point out in the story. The cost of all of this, though, is that it turns out to be a really troubling place to work. And the people who actually work in the stores, a retail job, wow, the stuff that they've gone through. So Brendan, Josh Idelson, but was lead writer on this. Brendan Case, also intimately familiar with it. Brendan, what was the reporting tidbit that made you and Josh just really want to dig into this?
There were a couple things, and one of them was what we say at the very beginning of the story, which was that if you look at a lot of the fines that the Labor Department through OSHA has levied against Dollar General, one of the things that keeps coming up over and over again is blocked exits, which obviously matters a lot to OSHA. It harks back to the Triangle Shirtwaist Factory fire in New York.
Which is actually a reminder, OSHA was founded because of that, right?
Yeah. Yeah, and one thing that surprised us was talking with an employee in New Orleans who said that in his case, the blocked exits were no accident. In fact, a manager had told him to purposely block exits to try to cut down on shoplifting, make it harder to get out of the store. That was one thing. Another thing that jumped out was just the lack of heating and air conditioning. And we talked with people who had put ice packs down their pants when it got hot, wore multiple coats and layers when it got cold. And one regional manager who, was fairly high up in the company who told us that she was just really shocked by how difficult it was to get funding for basic maintenance, basic upkeep.
So on top of all that, there's this sense that Dollar General has just been in this incredible growth strategy. So talk about how it's kind of swept the country a little bit, Brendan.
Yeah, and it's really amazing how fast it's grown. To your point, it's a little bit sort of a creature of the Walmart era. Walmart comes in and it wipes out a lot of retailers across the country and leaves a landscape that if you're not close to a Walmart or have a easy access to a car, you might not have as many retailers that as you had before. And so in swoops Dollar General and many of its rivals, and opens up stores to the tune of typically 1,000 a year. And so they've got more than 19,000 locations around the country right now. You compare that with a little more than 5,000 for Walmart, including the Sam's Club locations. And you start to get a sense of how ubiquitous it is, especially in smaller towns. About 80% of its stores are in towns of 20,000 people or fewer. And if you drive through through the countryside in many states, particularly the Southeast, but in many other parts of the country as well, you'll see store after store.
So we talked about the block fire exits. Can we also talk about the back guano? Because there's some of that in the story, Brendan.
Joel's been saying it a lot since he came in the studio.
Yeah, I was waiting to do that transition there. How crazy are some of the reporting details that you found?
Yeah, the issue of animals getting into the stores and befouling the merchandise is something that also came up over and over again. There was one case in Oklahoma where birds got in and used sections of the store as a bathroom, and the store manager there told us that he was told to just take the merchandise home, wash it in your washing machine if you have to, and bring it back and put it back on the shelves. There was another instance in which there was an Iowa store. There was a worry about asbestos, but after inspection, some state inspectors found out that it wasn't asbestos. That was the good news. The bad news was that it was stains from bat feces.
I mean,
this was all over a wall.
It's pages and pages of disturbing anecdotes, of disturbing experiences that employees have had. I mean, one thing that really stuck out to me was the employee who, if there's one employee in the store, the employee asking a customer to watch the store while he or she went to the bathroom. I mean, crazy. The thing that I was thinking throughout this piece is that this is working for Dollar General. They're making a calculation that they can allow their stores to reach this condition, pay their employees this wage, have this few of employees in a single store, because it's worked, especially over the past 5 years.
Yeah, it's really worked for a long time, and they've had, from a financial standpoint, a really strong record of sales increases and profit increases. One thing they're good at doing, and this is not true of all retailers, is opening new stores and fairly immediately having them contribute to the bottom line. Now, this year has been a different story for Dollar General, at least from a stock market perspective, where the shares have come way down. They've cut the profit forecast a couple times. One of the big problems, obviously, is just the financial pressures on their customer base, which skews towards the lower income. end of the spectrum. They have said, however, that they're going to spend more on labor. And that's at least, that's certainly an acknowledgement that the store conditions are not where they want them, and that they're starting to spend money to try to improve things this year. Another thing that's driving that, I think, is just a stepped up competitive threat. For years, Dollar General was known as, the big successful dollar store chain. Dollar Tree, its closest rival, was sort of an also-ran. That company's in the middle of a turnaround, and so, seems to be becoming a stronger competitor. And then you've got Walmart, which lost some ground to the dollar stores in the wake of the Great Recession, really doesn't want that to happen again if the economy slows down, and is rolling out a lot of initiatives, whether it's, pricing or delivery services that are designed to sort of counter competition on the lower end.
Hey, Brendan, and the stock, as you said, down more than 50% this year, trading at a 52-week low. What does the company say about all of this?
They reported earnings a couple weeks ago and, again, cut their profit forecast. And interestingly, they had initially said they were going to spend an extra $100 million on labor this year. They moved that number up to $150 million last month. So clearly engaging with the idea that for their own customers, their own workers, there are some things that are falling short right now. Whether that's enough remains a big question mark.
But what I mean about all these specific things, this is pretty gross for workers and unsafe for workers. And, we talked about the New Orleans worker who were blocking, the fire exits, and there was a fire. Unfortunately, nobody was there. But this stuff continues, and I'm curious if the company addressed any of these specifics.
The company told us in a pretty, we sent them a very detailed inquiry. They got back to us with a significant reply that repeated things they've said in the past, which has to do with them saying that they want to provide stores that are safe to work in. They want to provide opportunity for their workers. I think that a lot of the details in the story show the ways in which they've come up short in those goals. The extra investment they're making suggests that, they're sort of acknowledging some of the shortcomings. But again, whether that turns out to be enough to really kind of turn things around, I think the proof will be in the pudding.
And this is in the story, but it really does kind of culminate with a shareholder meeting where the employees really did get their attention. So we'll see where that leads. I do think, Brendan, when you just look at the incredible performance that the company has had on the stock market really until this year, what's happened? Because you would think, like, with the economy being where it is, inflation being where it is, this looks like a pretty good value proposition to an American consumer. And yet, you look at that share price and it's like, the ceiling of bat guano fell apart and everything fell apart. What's happened?
I point to two things, and one of them is tougher competition. I think Dollar Tree brought in a former CEO of Dollar General with backing from an activist investor, Mantle Ridge. Their comparable sales numbers suggest that they're getting some traction there, that people, consumers out there are noticing improvements and responding. That's one thing. Another thing is the whole issue of trade down. In the wake of the financial crisis, you had a lot of trade down from middle income, higher income people doing just what you say, saying, look, that's going to be a great bargain. I'm going to buy more stuff at Dollar General or Dollar Tree or other dollar stores. I think you're seeing a lot less of that right now. And where you're seeing it is in Walmart. And so I think that whether it's competition from small box stores like other dollar stores or competition from the really big ones out there, think Dollar General is under a lot more pressure than it used to be. Now, at the same time, by its own admission, it has this issue with store conditions. Can it fix the store conditions? Is fixing the store conditions going to be good enough to get back some of that business and get back onto a growth path in terms of comparable sales, store by store? That's an open question.
I just think about, too, that these stores do play a role, that there are small communities around the country, right, that don't have anything.
And as the story also documents, like some of these communities have actually resisted having Dollar General come in, have lost some of those battles. So there's this tension there. I also just think the moment that we seem to be at with labor in this country, with UAW doing what it's doing, Hollywood doing what it's doing, just to look at retail for a second and be like, oh yeah, there's this world that I don't think we talk about enough at Business Week, but this is, a landscape of what America really looks like, and the people who are on the front lines actually dealing with some of these issues that, you don't expect to have to deal with a machete wielding customer. And yet at Dollar General, that's part of your job description.
Yeah.
Even if you don't get training for it.
It's not in the training.
No, it's not. They made that point.
We laugh, but it's disturbing, and it's real for some folks. Incredible cover story. Brennan Case, Bloomberg News U.S. retail reporter, and of course the editor of Bloomberg Businessweek magazine, Joel Weber. This is the cover story.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, it's 3:47 on Wall Street here in New York City. And so we've just got about 12 minutes left in today's trading session. A Fed day. We've only got 2 FOMC meetings left, November 1st and then December 13th. But the Fed did not change its key interest rates, kept that unchanged, but did give an update in terms of its projections when it comes to the economy, to inflation. So we did get kind of what the Fed is thinking and where things go from here.
Yeah, it was hawkish nonetheless. 12 Fed officials seeing one more hike this year, 7 seeing rates on hold. The Fed also repeating language on the extent of additional policy firming. Let's hear what our next guest has to think about it. Larry Pitkowsky is co-founder, managing partner, and portfolio manager at Goodhaven Capital Management. Larry joining us on Zoom from Millburn, New Jersey this afternoon. Larry, how are you?
I am well. How are you, Tim?
Yeah, we're doing pretty well. Really digesting not just what Jay Powell said, but also the market reaction to this. We should note that NASDAQ pretty much at its lows of the day is down 1.3%. The S&P 500 down 0.8%. Stocks moving kind of all over the place when we heard from the Fed chair. What's your assessment?
Tim, I'm glad you had me on this show on a Fed day because I get to use my 3 favorite words in investing, which is I don't know. Okay.
Thank you for your honesty. Interview over.
And that's not that doesn't mean I wouldn't like to know, but there are many important and unknowable things in investing, and I think one can obsess over them all you like, but an enormous amount of energy may not yield you many results. And here at the Goodhaven Fund, we try very hard to focus on what is important and what is knowable. And what happened today with the Fed seemed to be within the realm of what has been telegraphed before. You have to look at the environment and say, okay, I have higher risk-free rates. I have a more constrictive policy. I have the economy slowing in some areas, and that is the backdrop. And we've been fortunate here at the Goodhaven Fund. We've had very good 1, 3, and 5-year results, and none of it has been because we've been able to make slightly better guesses as to short-term interest rates than the next person. So we will continue to try and do what we think we bring to the table.
No, I totally get it, right? Like, and all of this could change at the next Fed meeting, to be really completely honest, right? Or depending on the next set of data points. But having said that, Larry, you guys do have to make decisions. So how do you, first of all, do you pick like a 3-year time frame in terms of when you're making, or is it a 1 year? Is it a 5 year? Is it a 10 year? Is it shorter? What framework are you using to make investment decisions right now?
Carol, it's a very good question. And we are thinking very long term in anything that we purchase. We are stepping back.
What's very long term?
always,
Is it 10? Is it 10, 5, 10?
I would say anywhere from, let's imagine a 3-year on average holding period. I mean, our turnover ratio has been in the very low teens, so that would imply an even longer holding period. But first, there are plenty of confusing macro things out there. The first thing that I say to myself is this a period of an existential risk? The great financial crisis, there were existential worries there. The COVID, the tragic period and the lockdown of the economy, that was a potential existential risk. But what we are looking at today looks to me like one should assume this is the new normal, higher risk-free rates than we've had in a long time. The economy is slower in parts, but the sun is still coming up and businesses, things are still happening. And so once we conclude that there's not an existential worry, but there are things that are, there's higher deficits, all kinds of things, keep looking for businesses that we think can do well in such an environment and where we can buy them with a margin of safety. And that has worked for us over the last bunch of years, and we hope will continue to.
How do you think the consumer is doing right now? And I know this is, your investments are 5-10 years down the road, but now is an important snapshot to make these decisions. How is the consumer doing?
The consumer, I would say, looks to be, first of all, I've often said over the years that markets are much more volatile than the underlying businesses they represent. Having said that, over the last couple of years, I've noticed, and Artie Kwok and I here talk about this all the time, that the consumer and even business behavior is a little bit more volatile than it used to be. So I think the consumer in some parts of the economy seems much more constrained. Other parts of the economy, the consumer seems fine. So I think you have to take it. I think it's consumer spending in some areas, travel and leisure have been strong. Certain goods have been weaker. Luxury has historically been, more resistant to some of these issues. So I don't think you can just say the consumer, but I think it's a good question. And we then try and drill down a little bit beyond that.
So a listener and a viewer, Michael, thank you first of all for writing in and reaching out to our producer, Paul Brennan. He writes in and he asks, Larry, and I'm curious if you can weigh in. He asks, value investing hasn't worked for a long time. So how does an individual investor judge the past performance of a value-oriented mutual fund when considering a purchase? Also, is value investing working in more recent times?
Well, I like to first think that and I'm sure you have the statistics there in front of your trusted Bloomberg, that value investing for us and for our fellow shareholders has worked quite nicely over the last 1, 3, and 5 years, according to statistics that are right there, in front of you. I think that value investing sometimes gets a little bit, the term gets a little bit misused. There's nothing inconsistent in value investing with owning good quality growing businesses. And I think what has worked well for us and for our fellow shareholders is being right about the things that we bought, buying them at good prices, and not having any big mistakes in the portfolio over the last bunch of years. So I don't see, if you can execute on all those things, which is not easy, and why should it be easy? I don't see why value investing shouldn't always potentially work if you do a really good job at it. But of course, those are caveats, but I can only speak for what we've been able to do recently.
Yeah, I don't want to be a commercial for you, but the Goodhaven Fund, if I look at the 1 month, the year to date, the 1 year, the 3 year, the 5 year, you are consistently either in for the most part, the 99th percentile. So basically beating all of your peers in that category. If I look at the 5 year, according to Bloomberg data, on average annually returning 11% to shareholders, 3 year, almost 20% to shareholders, 1 year, 26% to shareholders. And if I look at your holdings, it's Berkshire Hathaway, it's Alphabet, it's Jefferies Financial Group, it's Lennar, it's Devon Energy, it's KKR. And these are names
Builders First Source, don't forget that.
Oh, sorry, which one? Oh,
Builders First Source.
What is Builders First Source? That's what that's a top holding.
It's a top holding and an enormous contributor to our recent results. It is a buildings products
up
distributor.
96% this year. Yeah, go ahead.
Up 96% and still trading at a very modest forward multiple to earnings and free cash flow. And we thank Paul Levy, who's the chairman of the board, and the rest of the management team, who has done a great job. And here's a shocking thing, Carol.
Yeah.
The stock is up dramatically in the last 6, 7, 8 years. Guess what? The earnings are up dramatically too. So when you get it right about the business and you buy it cheaply, wonderful things should happen to you eventually that the market will notice.
Well, and it's really interesting because this is a company that plays into, home building, which tells you a lot about the economy. Hey, do you want to mention Instacart just real quickly, because we've had some IPOs this
Carol,
week.
This is one of my decliners. Don't give it away.
Well, it wasn't a decliner yesterday, but it's sliding, 11% to fall below the $30 IPO price. People were talking about the low float on this one, right? There wasn't a lot of shares out there and how that could be maybe problematic for investors. So we'll talk about it. Well, hey, Larry, we've got about 30 seconds left here. The IPO market, anything interesting? Does it tell you anything too also about the health of the overall market? Just quickly.
No, we have exposure.
This is why we like you.
No,
yeah.
we have exposure to Jefferies, wonderfully run by the very talented Rich Handler, and so we hope that if there are more IPOs, we fully expect that their bankers will get more than their fair share, and so we cheer them continuing to do a good job if there is a more robust IPO market. IPOs are, not necessarily the things that we've historically focused on in the portfolio, but I'll think of where we will be cheering for them, and that's as fellow owners of Jefferies, which has worked out very well for us.
That's interesting exposure to IPOs, right?
Absolutely.
One of the companies one of the banks that handles underwriting.
Brings money into those firms. Larry, we always enjoy talking to you. You're specific. You aren't bashful, and it's really fun to get you to weigh in, certainly on this Fed Wednesday. Larry Pitkowsky, managing partner, portfolio manager. He's also the co-founder of Goodhaven Capital Management, on Zoom from Millburn, New Jersey.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.